There's too much misinformation out there about gold and silver, and about money in general. Some of the stories that are made up are very attractive. We want to believe them because if they turn out to be true, we can get rich quickly, just by being in the right place at the right time. For example, there is an entire investment business that has grown up around the story that all a person needs to do is put 5 to 10% of his salary into a stock mutual fund in a 401k, and then by the time he turns 60, he'll have enough wealth to retire and live off of the dividends, never having to worry about depleting the funds in the account. A whole generation has bought into this story, and they are counting on it to be true. The same investment industry that sells us the stock market dream tells us that gold and silver are terrible investments because they don't pay interest or dividends. Many buy into this story, shunning gold and silver in favor of purchasing financial assets that do provide a return. Yet, as even Alan Greenspan just admitted before the Council of Foreign Relations, gold is the premier currency. And he asked this rhetorical question: why do central banks put money into an asset which has no rate of return, but cost of storage and insurance and everything else like that? Why are they doing that? If you look at the data, with very few exceptions, all of the developed countries have gold reserves. Why? Well, why indeed? And while we're at it, we should ask ourselves the question, why do the world's super wealthy hold billions of ounces of gold, more than the central banks do, if it only costs them money to store it and it does not generate a rate of return? Well, I for one know that the statement, gold and silver have no rate of return, is false. The wealthy of the world know how to make it generate an income, and I'm going to show you how they do it in this video. And understanding how they do it is one of the secrets to understanding how the world of gold and silver works. Most gold and silver buyers will not have the means to do what the truly wealthy do. But understanding what the wealthy do and following the clues behind the movements of gold and silver can help the little guy walk in the footsteps of giants. It can help the little guy dispel other myths about the precious metals that can be equally damaging, such as stories about imminent silver depletion. Let's explore how gold and silver can generate interest payments together. First though, I'd like to take a step back and discuss a couple of banking concepts. Bear with me, it will become clear in a few minutes where we're heading. Let's start with the concept of full reserve banking. I don't think that there are any such banks left in the world, but there used to be. A full reserve bank is one that acts only as a vaulting service. It's a place where you can take your money and store it. The money isn't used for anything. It just sits there in the vault, segregated from everyone else's funds, ready to be withdrawn upon demand. In this arrangement, the depositor will deposit funds, the bank provides storage and security. The bank might also do some paperwork. In exchange for this service, the depositor will pay the bank fees. This runs counter to the way that banking is currently done. Most people nowadays think that banks must pay interest on a deposit. And let's explore why this is so by taking a look at fractional reserve banking. Before we do though, please note that I never said that the money on deposit has to be a fiat currency. Keep this in the back of your mind for later. Fractional reserve banking is a different system. It's what's generally in practice today. Rather than the bank keeping all of the money in safe storage, the bank will deploy most of it in loans. A small portion of the deposits are held in reserve to fulfill the occasional requests some of the depositors make to withdraw funds. It is this feature that makes the system fragile, but we'll talk about that in a minute. For now, let's just focus on the investment operation. The bank earns a return on the loaned funds. Some of the income from the loans is used to pay for expenses. Some of it generates profit for the bank. The rest of it is returned to the depositor as interest. So in a way, the depositor becomes a partner of the bank. The bank acts as an intermediary, evaluating risks and collecting interest. The depositor supplies the funds. So instead of the depositor paying the bank for safeguarding the funds, the depositor earns interest instead. The depositor is a creditor who is taking risk in order to earn a return. Most depositors don't realize that this is what they are doing when they make a deposit, but it is. It is partially the fault of the banking industry for not making this more clear, but I think that some of the blame must fall on the part of the depositor himself. Everyone who deploys their wealth must take responsibility for understanding how that wealth is used. And to better understand how the bank makes money, let's introduce the concept of the yield curve. This curve, while ordinarily associated with loans of fiat currency, is central to our discussion of how gold and silver are deployed for profit. So please bear with me for a little while longer. A yield curve is simply a representation of the going market interest rate for loans of a particular quality expressed as a function of loan maturity. Curves can be drawn for U.S. Treasury debt, other sovereign government debt, municipal debt, corporate debt, and so on. As long as the debt is of the same quality, the interest rate charged, as determined by the market, will simply be a function of the duration of the loan. Short-term loans will pay relatively low rates of interest. Longer-term loans pay higher rates of interest to compensate the lender for the risk taken by loaning the money for longer periods of time, and also to compensate the lender for tying up his money for longer. The banking system takes advantage of this fact, and it is how the banking system makes its profit. The bank simply treats the depositor's deposit as a short-term loan to the bank. It pays the depositor the short-term interest rate, or even less, and the depositor has little room to argue. After all, the depositor generally enjoys almost instant access to his funds, and so calling the deposit a short-term loan is appropriate. On the other side, the bank generally lends the money out long-term. The long-term loan has associated with it a higher rate of interest. And so we see that the bank's profit before expenses comes from the difference between the short-term rate and the long-term rate. The bank borrows money from the depositor short-term, lends the money long-term, and it pockets the difference in the interest rate charged. It's worth noting here that the yield curve is a very useful tool for evaluating demand for long-term credit. When the yield curve is steep, it's a sign that demand for long-term credit is high. When it's shallow, it's a sign that the demand for long-term credit is low. Thus, the yield curve is a pretty good indicator of demand for long-term money lending. Keep this in the back of your mind for later, because it works the same whether the loan is a fiat currency or precious metals. More on that in a few minutes. So what I've drawn here on this chart is what a healthy yield curve might look like in normal times. But right now, conditions are not normal. So let's show the yield curve as it stands today. Today, we see that short-term interest rates are near zero. This is why depositors are not getting paid much, if any, interest for lending their funds to the banking system. Long-term rates, while historically low, are still several percentage points above short-term rates, and so the banks still make plenty of money. They simply don't have to pay as much to the depositors. So as you can see, the banks themselves don't really care what the absolute rate of interest is, so long as there is a sufficient spread between short and long-term rates. The depositor, on the other hand, cares a great deal. In fact, the depositor is likely to become quite angry with the bank simply because it will look like the bank is making plenty of money by using other people's funds and by not providing any compensation in return. It's certainly a legitimate complaint. After all, the depositor, whether he realizes it or not, is taking significant risks by lending the funds to the bank. And let's discuss what those risks are now. I've alluded to the main risk a few minutes ago, and that is that the depositors are under the impression that they can access their funds upon demand. It's a mathematical impossibility for this to be true for all investors, for all of their funds, because the majority of the funds are tied up in long-term loans. The banking industry counts on the fact that only a few investors will request to withdraw their funds, and usually only a portion of what they have on deposit. In good times, only a few percent in reserve is sufficient to meet the withdrawal requests. Sometimes, however, depositors get nervous about their funds, and they will show up en masse. This is known as a bank run, which the banking system wants to avoid at all costs, and this is the reason why the banks all joined together as a cartel. If money taken from one bank is always put into another, then the system as a whole can survive. The other risk that the investments made by the banks will go bust. Generally, the banks are required to carry loan loss reserves to minimize this risk. Most of the time, this is sufficient, but there is still a large risk that too many investments will go bust at the same time. If this happens, then the banking system as a whole collapses. The FDIC was set up to provide depositors the illusion that they can be made whole. But again, if one examines the mathematics of the situation, one will conclude that this is in fact only an illusion. Now that we've gotten the preliminaries out of the way, let's talk about how the banking system works when precious metal is used as the money instead of fiat cash, which we are accustomed to thinking about. So guess what? While the masses have grown to adjust to a system where precious metals are no longer used as money by the general population, precious metals remain the money of the wealthy. There is an entire banking system based upon loans of bullion. Let's see how it works and draw some analogies between this banking system and the one that we are used to dealing with. The depositor, in this case the wealthy family who owns precious metals, makes a deposit to a bank. This is no ordinary bank. This is a bullion bank, whose charter it is to deal with special types of transactions involving precious metal. The bank makes loans of bullion. Who would want to borrow bullion? Well, primarily, it's the producers of bullion. It's the mining industry, whose job it is to search for bullion deposits, build mines around identified deposits, extract and refine the bullion, and sell it to the open market. The problem the mining industry faces is that it generally takes quite a bit of time and cash between the time exploration starts and refined product can be supplied to market. The mining industry needs funds to operate. So what they do is they borrow the bullion that they can sell immediately, in return for an agreement to pay the bullion back out of future production as well as a payment of interest. The bullion bank will return the bullion to the depositor, plus a portion of the interest earned from the loan operation. Does this look very similar to the fractional reserve bank example that I showed you a moment ago? It should. So let's explore how it is that the bank makes its profit. What I'm showing at the bottom of this slide is a curve of gold market futures prices on the COMEX. I'm sure many of you are familiar with what a futures contract is, but for those of you who are not, let me briefly explain. A futures contract is a contract between two parties where one party, the long, agrees to purchase a particular commodity at a prearranged future time for a pre-negotiated price. The other party, the short, is the party who has agreed to supply the commodity in return for an agreed upon sum of cash. It's pretty simple, really. Futures are how producers limit their risk of price fluctuation when they make investments which will only produce product in the future. It allows the producer to lock in the price so that they will know whether or not their investment will generate a profit. A futures price curve is just a representation of what a futures contract currently costs as a function of its expiration date. In general, the longer the time horizon, the more expensive the futures contract will be. This may seem counterintuitive to those who are unfamiliar with futures markets. After all, isn't obtaining a good immediately more valuable than obtaining a good in the future? Why would the buyer be willing to pay more for a good further out in time? It really comes down to storage. Think about it this way. Suppose you were purchasing an item but didn't want to take delivery of it right away. Somebody is going to have to store it. The storage is going to cost money. So a person can think of a futures contract as a claim on a good in storage. It is the owner of the claim who is going to pay storage costs. In this case, it is the bullion bank who is providing storage services. So part of the money that the bullion bank is making is for storage services. Let's take a look at the gold loan and see how it works in order to make the bank some profit. We can visualize the gold loan in terms of the futures price curve. The bank loans the bullion to the mining industry. The bullion the mining industry wants to sell now is sold for the cash price, which generates the cash that the mining company needs. In this case, the mine gets about $1,200 for each ounce sold. The mine agrees to pay back the loan with interest. And what is this loan? Well, it's a futures contract. The mine is on the short side of the deal. If the loan is a 5-year loan, then the 5-year futures contract is generated by the mine and sold by the bullion bank for $1,280 per ounce. And who is it that takes the long side of this trade? Well, it's the party that wants to buy the bullion. Remember, the buyer of size won't necessarily want to move the bullion. The bullion can just stay in the vault at the bullion bank. So the buyer of the bullion, rather than paying spot pricing and taking delivery, will leave the bullion sitting where it is. He will buy the futures contract, which is essentially just a warehouse receipt for future delivery. The bank, as the provider of storage services and market maker in the deal, earns the spread between the spot price and the futures price, in this case about $80 per ounce. It's a pretty good deal for the bullion bank, really. But what about the depositor of the bullion? How is the depositor who lent his bullion to the bullion bank compensated? Well, to understand this better, we need to look at the futures market curve in a bit of a different way. Let's express the futures price curve in a similar fashion to the yield curve. It's pretty easy to do. All one needs to do is to take the percentage difference between the spot price and the futures price and calculate what rate of return would be needed to generate that price difference in the given period of time. When we do this for the futures price curve for all expiration dates, we obtain the equivalent of a yield curve. The simplest way to understand this curve is by imagining that you are a gold warehousing service. If you have committed to store gold for 5 years in your vault, you take possession of gold at a spot price of $1,200 per ounce, and then you sell a 5 years futures contract for about $1,280 per ounce. In 5 years, you can deliver the gold and keep the difference in price. You essentially earn a return that is the equivalent of 1.4% per year. The rate of return that you earn for your storage services is simply dependent upon the duration of the deal. Please note that this curve is essentially the same thing as the GOFO curve that is published by the LBMA. So for all those who are fretting about the rumored discontinuation of the publication of the GOFO, don't worry, because you can reconstruct it very easily for yourself just using the futures market price curves. And now we're ready to understand how the depositor of bullion makes his return on his gold or silver. The depositor of the bullion will be using the vaulting services of the bullion bank, and so will have to pay for the storage and security services according to this price chart. But the depositor can exercise his option to mobilize his gold for cash. In other words, he frees up the gold for delivery and puts it in the registered category at the COMEX. And by doing so, he can have access to the cash that he can then deploy for profit. Let's see how this works. Remember the yield curve that I showed before? Well, during normal times, the yield on government debt will far exceed the cost of mobilizing and storing gold charged by the bullion banks. When this happens, the depositor of bullion can lend his bullion to a bullion bank in return for cash and a guarantee of return of bullion in the future. In other words, the depositor sells the gold at spot, buys the futures contract on margin, and uses the cash to lend to sovereign governments, usually with the assistance of the bullion bank itself. If the depositor is certain of the return of the gold and the honoring of the debt by the sovereign government, then the bullion owner can make a pretty nice profit off of his bullion. The bullion owner is using his bullion to generate interest with the guarantee of return of the bullion later. It's a neat trick, and it's not something that you and I can do, but it's worth understanding the mechanism. Of course, this is very similar to the fractional reserve banking system, and it has its risks. We should familiarize ourselves with these risks so that we can understand what might be going through the minds of the major bullion owners right now. Now, the bullion owners are pretty savvy. They know all about duration mismatch, and they know that not all of their bullion can be accessed simultaneously. They know that if withdrawals are to be made, they need to be made gradually. In their minds, the major risks are the risk of major mining industry bust. In this case, the futures contracts will not be honored and return of the bullion won't be made. It is the equivalent of a complete loss of capital. This would trigger a default on the short end of the futures market. The other major risk is that the cash that was lent to the sovereign government is not returned. This would trigger a default of a different kind. It would result in the cash not being available to settle the futures contract when it comes due. Again, delivery would not be made, but it is triggered by a default on the long side of the futures market instead of the short end. Both events would lead to the same disaster, but the causes are quite different. And this is why the cash generated by bullion loans is generally deployed into the safest sovereign debt markets, and why the bullion depositors generally require that the loans be backstopped by the same sovereign government. In other words, the sovereign government who borrows the cash generally pledges some of its gold as collateral. Hopefully you're still with me. It's been a little bit more than 20 minutes now into this presentation, but the material that I presented is crucial to understanding our current market situation and the movement of gold and silver on the exchanges. Let's see what the rate curves look like currently. Here I've drawn the current Treasury yield curve as of this past Friday, November the 21st, 2014. Notice that short-term rates are close to zero, and longer-term rates, those out to about 7 years, are only about 2% per year. I've also calculated rate curves for silver and gold using spot and futures market data at the end of the day the same day. If you followed the discussion over the past 20 minutes, you'll probably immediately recognize the big problem that currently exists. If not, let me point it out to you. What we have right now is a situation that is quite bad for the bullion banks as well as for the U.S. The rates offered on U.S. paper are so low that the bullion depositors cannot profitably deploy their funds into debt. In other words, if they lend their bullion long-term to the bullion banks and deploy their funds in the paper market, they will be gradually eroding their wealth, which is not something that they want to do. So we can expect that longer-term, gold is going to withdraw its bid for U.S. paper. The situation is also very bad for mining companies because they will find it very difficult to obtain bullion loans to keep their operations going. On the shorter end of the curve, we can see that the bullion banks themselves are in a very unenviable position. Short-term futures contracts are actually a little cheaper than spot pricing right now. This is a sign that there is a squeeze in the physical bullion and that the bullion banks are worried about making delivery. They are essentially offering the bullion depositors a profit simply for depositing their bullion. In other words, short-term bullion depositors are given the promise of a return without having to deploy their money in the sovereign debt market. The bullion banks are paying people to deposit bullion with them. This is the backwardation in the silver and gold market that many have pointed to. We'll have to see if this situation persists, but if it does, then it's a very bad thing. If the metal is not supplied, then default is likely to occur. What the bullion owners have to decide is whether or not the return is worth the risk to their capital. So if we read the tea leaves in the rate curves of silver, gold, and the U.S. Treasury market, we can get a clue as to what the market problems might be. Let's take a look at what's happening to the inventory of the metals so that we can try to get into the minds of the participants in the market. And we can use the COMEX statistics, which it provides us periodically. Let's look at silver first and see what the owners of silver are doing. Here I've plotted registered, eligible, and total silver deposits at the COMEX warehouses going back to the year 2002. Eligible inventories are simply deposits made in the warehouses that conform to exchange standards of weight and fineness. They are deposits that could possibly be made available to the market at some point in the future, but are not currently available to be used in settlement. In other words, they are just being held on deposit as if the bullion banking system was a full reserve type of banking system. Registered inventories also conform to exchange standards, but this inventory is in play. It is metal that has been made available for delivery. We can see an interesting trend. New silver has been deposited in the COMEX warehouses since the peak in the market in 2011, and inventories are building. Some of the increase has been made available for delivery, but a good portion of the increase is in the eligible category. It is simply being held in storage. Silver has no chance to gain by mobilizing itself and bidding for U.S. paper, so it's probably simply taking advantage of the backwardation in the market. The bullion banks are in a bind, and silver is showing up to make a profit from the situation. I think that once silver has profited from the misfortune of the bullion banks, the backwardation will resolve itself. There is unlikely to be a default. Silver knows this. If the risk of default was high, then the owners of silver would not take the risk of making their silver available. The risk of total loss would just be too high. Let's now look at what gold is doing. Gold is clearly smelling danger. Like silver, it has no real opportunity in the paper debt market, and so it's just not playing. Unlike silver, it is actually disappearing from the COMEX and has been for several years. The registered inventory has been declining for several years, and it's now considerably lower than 2002 levels. Gold is not being made available for delivery. Most of what remains on the COMEX is in the eligible category, where it's not in play. It is simply being held in storage, as if it was being stored in a 100% reserve banking system. It's not taking advantage of the backwardation that's present in the market. It doesn't trust that the tightness in the physical market can be resolved, and so it's not taking any chances. But even the eligible category has been dwindling over the past few years. Gold seems to be smelling danger. It is withdrawing its support for the mining sector, and it's withdrawing its bid for U.S. government debt. Gold has been gradually going into hiding. It will be interesting to see what the future holds if this trend continues.